Hello, everyone. Welcome to our 529 Enable Solutions webinar series. We're pleased to have you join us today for our October webinar, 529 Advisor Channel and Stable Value Products, sponsored by New York Life. Just a couple housekeeping items before we start the presentation. If you have any questions during the session, we invite you to submit them through the Q&A section in the engagement panel on the right side of your webinar screen. We'll do our best to address questions as they come up during the session, and we'll answer any remaining ones at the end of the presentation. If we do run out of time, we will follow up with you directly. If you have any issues viewing the presentation or hearing the webinar, we recommend that you try to refresh your browser first. And if you continue to, please submit anything in the Q&A and we'll try to address it. So I'll now hand the presentation over to Paul Curley, Director of Savings Research from the 529 Enable Solutions team at ISS Market Intelligence.
Thank you, Mary. Much appreciated. Paul Curley here, and we're going to be joined here today with Ed Kaminski. He's the Senior Business Consultant of New York Life Stable Value. He's got his email right there, but a couple quick facts. He's got a Series 7, 63, SEMA, ARPC, AI, FC, FS, and a few other ones. So definitely, well trained here. He's a graduate of Pace University. Got his MBA there. He's which is the setter dog. Right now, Ed, it's $68,000 a year right now, and Rachel Ray's a graduate from there, and of course with all the home cooking we've been doing recently, I'm a big fan of her, and of course Pace University by extension. Of course, Farley Dickinson, graduate, Nitro the Night, only $60,000 a year, which is still outrageous. I'd love to hear when you jump in later how much it is now, or how much it was when you went back there. But what's interesting, of course, he's currently with New York Life, but before that he was with ADP, which aligns great with the employer channel trends that we're seeing, and of course he's also the College Savings Foundation CSF board member. So it's great to see Ed in normal times once a quarter and talk shop, and so we look forward to hearing more about his perspective here today. And in terms of the agenda for today, as we do every single month, we'll start out with some industry announcements. We'll talk about data and research updates. For today, in our content section, we'll talk about the Advisor Soul channel and Stable Value product training. Look forward to learning more about that. And for the question and answer, please feel free to ask questions and answers throughout. We'll be taking them, we'll be answering them throughout, and definitely within Ed's section, let's pepper him with questions, and I'm sure he'll be ready. Before we jump in, we'd like to do a quick poll, and just in terms of just learning more about the audience here today. What is your relationship to the 529 and Able market, whether it be on that financial advisor and broker dealer home office side, whether it be the product provider and distributor side, and then looking about that, probably also the IO investment manager side would fall in that category as well, state agency and treasury department. And I'll take a quick peek on my side of the platform to see how the answers and responses are coming in, and we will give that a moment. And as a quick response, as we've had in the past, looks like a great divide, and it's always very helpful to get those responses in terms of just learning more about, just making sure we're presenting the right content at the right level, right different topics, and make sure we're blending it in. So it pretty much has a good divide between the product side, the state side. The other category looks fairly large, so we'll take a dive into that one, Ed. Perhaps the record keeper side or other industry consultants, but we'll take a look, and as we get the questions coming in, we'll be sure to make sure we feed you in the information, Ed, just to help answer it, let you know who's asking the questions so we can better answer it. So that should be good. Thank you very much. Yep, it was almost like a perfect divide. About what a fourth financial advisor, a fourth product, a fourth state, and a fourth other. And in terms of industry announcements, we continue to do this webinar series as a means to provide that ongoing momentum, dialogue, conversation throughout the industry on both 529s and Able. Keep that momentum going. Of course, in the realities of today in the world of COVID-19, it's great to have this as an ongoing kind of voice, and really just kind of keep that momentum going on that conversation side. So thank you for that opportunity, and much appreciated. And as we think about that webinar series, we've been, we started out with that fundamental products. We talked about legislation, some trends, product focus, employer focus. one thing that's pretty exciting to say is that we're talking about the distribution side and the product side, and we'll be closing out the year with a couple more up and coming. But I did want to note that if you do want to see like a prior webinar, that it will be links to the prior recordings of past webinars will be in that email. And as a quick update, like a summary of the 529 Conference 2020, we had it in mid-September. It was a virtual event. Just did want to provide a special thank you because many of those here today did attend that event. There was 236 attendees, 17 sponsors. We had post-event surveys so we can improve going forward. And it's always great to kind of get that ongoing feedback because each and every year we do try to, make the adjustments and improve over time. So, thank you for the attending, thank you for the support and for the post-event survey, and a recording of those sessions will be available for those attendees through the end of the year. And in terms of 529 plan updates, in September, for the Oklahoma plan, the program manager for the Oklahoma Advisors Hold plan, the program manager shifted from TIA over to Fidelity Advisors. The primary distributor changed from Allianz to Fidelity Advisors. So that's a larger structural product change that took place in the industry. Also in October, T. Rowe Price has announced a number of enhancements to the investment lineups that will result in lower fees, whether it be changing the share class that they're using, or also shifting the exposures and adding new kind of investment blocks to their investment lineup, and they'll be doing that over time. Of course, on the right we have some of the photos from the 529 conference. Paul Masanti is there on the right from T. Rowe Price. That did present at this year's event. So it's great to find a way to work in different photos into our presentations. Of course, Ed knows that I love to take live photos, whether it be at a CSF board meeting of Ed there and having him on that photo when I presented to his team. So of course, if you do an event with me, you can almost guarantee that I'll be taking some photos. But in terms of other items, that Secure Access status board continues to update. Also, the K-12 status boards also continue to update, rotate, and we continue to track that and report it out in the 529 Insiders website. Quick update on the data: the assets, number of accounts continue to rise. The assets are going to land at that $362 billion at the end of the third quarter, and number of accounts 13.8 million. Of course, that photo on the right is from the Outlook session, so it's great to kind of find a way to think about where we are today and where we're going. And of course, that session talked a lot about where we're going. And for thinking about the shift, I did come across this item, and I thought it was great prep for this session, and that deals with basically speaking, the number of investment options offered within, by investment type, whether it be age-based, asset allocation, and individual funds. We've seen more and more investment options launch within that individual and asset allocation, bucket. And of course, that's a great sort of, timely piece to kind of set up, Ed's discussion for later, that there's more and more, discussion around the expansion of individual and asset allocation investment options. And of course, we'll hear Ed talk about that topic today. And within the ABLE column, but the IRS issued final rules on ABLE accounts, and they also sent out an email today just highlighting some of their ABLE videos that they have completed. Connecticut launched a brand new ABLE program. Stable Ohio announced that further block of block of states using that pivot around the Stable program will be changing administrators from Intuition over to TrueLink. We have AKF Consulting that came out with a state-run retirement report that brings out a lot of parallels from the 529 and the ABLE industry to talk about the state-run retirement. Of course, as we'll see later and announced probably next month, AKF Consulting is hiring an additional new analyst to cover ABLE, so we look forward to announcing that one shortly. On the ABLE side, we do continue to see assets and accounts grow, and once we finalize the numbers, there'll be over 75,000 accounts investing over 538 million in assets. And of course, that photo is from the ABLE Outlook session from the events. What we're focusing on our side of the table is that we're going to launch next week a new survey of advisors for the 529 distribution analysis. If you're an advisor on the call and you want to participate in that survey, drop me an email. But if you're on that product manager, distributor side of the table, and you want to learn more about this study and learn more about what's on the minds of minds of advisors from a legislative, product marketing, and distribution perspective touch base, and we'd be happy to talk more about that study. So more to come. And of course, this photo comes from the broker-dealer home office panel from this year's 529 conference as well. So diving into the 529 Advisor School channel, there's really three main driving points that we continue to focus on in terms of the importance of doing the education financial planning business. One is to engage the next generation. And the last thing that you want is to meet the beneficiary of the account at the funeral. So that, it's so important to build that connection to the next generation. And education financial planning 529 plans are the perfect link to that. Should be doing the business anyways. It's a number one or two need in terms of the parents, especially those with children, and grandchildren, aunts and uncles and nieces and nephews. So it's a top one or two priority. So more and more advisors should be having the conversation because it's a need for the client. And of course, don't leave the money on the table. There's so much state and federal tax incentives, to do the college financial planning in 529s that one really should be doing the business regardless. But of course, my friend Mark Struthers out in Minnesota, being a Vikings fan, of course, but having a great 529 plan, college financial plan also helps the retirement game, just because there's so many people that raid their 401ks and IRAs to pay for college, that having a great college financial plan does protect against other goals. So thank you, Mark, for doing that podcast with me last week. It'll be floating out next week. So, in terms of market data that we do see, it's just that 529s are a great way to, retain clients. It's always been one of the main bullet points. And one thing that we have been seeing increase year over year is not just 529s and college financial planning, a great way to retain clients, but also a great way to acquire clients as well. And of course, we kind of, mentioned whether it be Joe Messenger and all the great stuff that he's doing, or Brock Jolly, who working with all his advisors to really help other advisors to build out their book of business through college financial planning. So that's a great quote in the bottom, and I think it captures the conversation quite well. In terms of other items, we see the expanding list of omnibus type accounting, which is really making the broker-dealer, just operations of doing the business easier for the advisor. It's just so much easier for them to see the assets, because the 529 and college financial planning assets is in the same page as retirement and everything else, as opposed to being held away and having to, network in or just report in to the same item. Just makes the ease of doing the business so much easier for advisors in home office. But of course, which is very much front and center in 2019 and 2020, that compliance enhancements as well in doing the business. Columbia Threadneedle, for example, has added Edward Jones and Raymond James very recently. So it's great to see that list expanding. And of course, we also heard a lot more focus around fee-based advisory share classes expanding. Morgan Stanley National Advisory Plan, it went live in September in terms of just national rollout, but is really launching, this, month. So we're seeing much more focus around that advisory share classes. And of course, that list continues to grow and grow. Not too long ago, there was only 5 plans on that list. So it continues to grow. And of course, so I guess in the graphic there, it looks a little bit tight, but that's just the reality of it. So the advisor demand for stable value investments in 529s continue. This is our looking at basically this last year's 2019 survey compared to 2009. Broadly speaking, stable value continues to be a mainstay for financial advisors in terms of demand. In terms of other conservative investment lineups have been continuing to drop. And as I was even chatting with Ed earlier this week, I think with all the market volatility, especially that took place on Tuesday, it's great that we were able to dial up that market volatility for you, Ed, to make this a very timely presentation. I think with everything going on, everyone would like a little bit more stability in their in their life. So I think it's a very timely topic. So we look forward to hearing more. But also of course, there's Jerome Powell and Jay Powell talking more and more about all the different movements in the interest rates and just the low long-term interest rate environment makes this a very timely topic. So we're going to be talking about stable value product, providing some product training, and look forward to learning more about it. We'll just do a quick mic check with Ed to see if he is online. Can you hear me, Ed? Ed?
Yes, can you hear me?
You? Yes.
All right. So you're turning it over to me. Thank you, Paul. And as I get into the presentation here, Yeah, those numbers were pretty impressive. It's a five-bagger. I know that from undergrad, but fortunately I had athletic and scholarships as well as some academic to get me through. And then I was at a wonderful organization for my MBA, and they picked up the bulk of it. So, but things have changed. And quite frankly, that's why we are here as an industry today. The dynamics are much different. But the one thing I'll add to my background, Paul did a great job. I spent the bulk of my background in the retirement space, and quite frankly, learned a lot there. There's a lot of parallels between the retirement space and the 529 space, although 20 years removed. And at the end of the day, some of the things that I'm going to say and my perspective was shaped by, quite frankly, what I lived through during the market downturn. And what happened in the capital preservation space at that time. So the purpose of the call is to give some of that perspective, is to say that there's no inherent better structure of stable value. One's not necessarily better than the other, or other capital preservation solution for that, for that standpoint. But the goal is just to make sure we give you a perfectly balanced perspective on your due diligence, on what the market is, to help you all make better decisions either for your programs or for your clients. And of course, you see some slides here from New York Life about who we are. At the end of the day, we've been in the business, just as long as anybody else. We offer all the different types of structures, so synthetic, general account, separate account, custom, as well as provide wrap coverage. So we have really no horse in the game in terms of a preference at all. And quite frankly, we serve the 529 business and industry in different capacities. And at this point, we are in over 20 states programs. So just wanted to give you that background. Right. So what is stable value? The simple definition is it's an intermediate bond portfolio or thereabouts with a wrap contract and insurance contract attached to it. And we'll get into more of an illustration in a little bit. Stable value structures for 529 programs are primarily in the synthetic space and in the general account space right now. Those are the two primary options there. So we really won't spend any time on this separate account right now. And then, of course, we'll move over to due diligence, why it's important, and just some best practices in due diligence for stable value. So here's an illustration in terms of the risk reward or the risk spectrum. I'm sure most of you have seen this. Quite frankly, an argument could be made that stable value could be even left of money markets at this point with what's happened over the last several months. But I'll leave that up to the pundits to definitely place it. At the end of the day, it is a capital preservation option. It's not a mutual fund. It's not guaranteed. By the government or the FDIC. So that's a couple things to keep in mind. And in terms of one theme that we have seen over the last couple of years, there's been great conferences, including Paul's organization. We've had a lot of speakers, great speakers from great companies that do very well sound presentations. So I think the case there is made that, it's really when you put stable value next to the other capital preservation options, it's not even a fair fight, to be quite, not that glib with it, but maybe on a glib side. And here's the illustration why, right? So you'll see in the blue there, I know it might be a little hard to see, that's an intermediate term bond index. The red is a money market index, and the green is the stable value index. So put another way, you'll see it this way in the risk reward chart. Stable value overall is in a very rarefied and coveted space. So very low volatility, which is equal to that or thereabouts to money market, with the returns comparable to that of an intermediate term bond portfolio. And to put it all in English, here's a chart, your basic growth of a dollar chart. So it illustrates the red again is the money market, and you see the green and the blue being intermediate term bond and stable value not too far behind. So very comparable there. And here, drilling down again, just another slice of it. the stable value versus money market, the average monthly returns going, and all these charts go back over 30 years up to the most recent quarter, meaning 6/30. And what this basically tells you is, and confirms, is what we've been saying all along, that at the end of the day, you can expect historically stable value to deliver anywhere from 100 to 200 basis points more than a money market fund. So here's a couple different, here's a side-by-side actually with the two primary structures. So you have your synthetic versus the general account. So over here, the ownership of the assets, it's really, I wouldn't be too glib to say it's not a big deal. It is a consideration, but at the end of the day, everybody, these are both liquid forms and everybody gets their money back. But nonetheless, legally, the plan owns the assets in the synthetic and the insurance company owns the assets of the general account product. What else do we have? The crediting rates. So in terms of the crediting rates and how the money is made for the clients, that is a portfolio rate. So for synthetics, the underlying securities spit out a rate. It's credited it's daily rates and then credited monthly typically. And then whereas what sets the general account products apart is that there are direct guarantees. So what do I mean by that? Actually, I'll elaborate a little bit below there, but let me see this. Yeah, so other things to be considerate of are, of course, fees, transparency, and exit provisions, which we'll get into a little bit more. But going back to the guarantees, of course, there's guarantees embedded in any stable value. For the synthetics, it's your return of principal and accrued interest. The same is true with the general account, but why general account has really been attractive to many in the 529 space, where it's I would say more of a conservative clientele, is because it offers, like I said, direct guarantees. So guarantees in terms of interest that is announced to you and to the public in advance for a certain period of time, and that could be quarterly, it could be semi-annually, it could be annually. So you know what you're going to get. The insurance company is making that promise to you. And then also, especially in this day and age, what is very important and what resonates is a guaranteed minimum interest rate. So right now, our product offers 1%, and others, tend to coalesce around that as well.
And Ed, for the on the synthetic multi-wrap, for the investment guidelines, is there typically like one underlying manager, or is it several? Is there like a norm around that one, or?
Yeah, no, I'm glad you asked the question. So typically it's multi-wrap, multi-manager. But I'll illustrate that for you in coming slides as well. But a great question. So typically you do see multiple managers and multiple wrap providers in synthetic. So thank you. So yep. I'll pause there. Are there any other questions right now, Paul?
Not from the audience, but for me, I was curious around the on the insurance company, like general account for the investment guidelines on that side, specific to the investment guidelines of the insurance company's general account. Can you just provide like one notch deeper on that bullet point? Just to help clear it up in my mind.
So you're talking about explicit guidelines or transparency, or both?
I mean, it's kind of it's kind of interesting. Like it's sort of like a blanket statement. It's like, oh, it's the the guidelines for the insurance company. And I guess my question is it sort of, is it sort of one way to look at it, like these buckets of different investment options, and then it's like one layer of insurance policy over that, or am I thinking about it the right way, or?
Yeah, so typically what happens is when a stable value fund is set up, a general account, it is ultimately commingled along with other products in the general account of that insurance company. But there is a sleeve, and there are consistent investment guidelines across all products that the portfolios are managed to. But for instance, the GIA, the guaranteed interest account, it would be managed in a similar fashion, but the duration would be lower than, let's say, some further out product where longer duration is needed. So it is a separate sleeve of the general account. Certainly, part of the due diligence process, and I'll get into that, is making sure that you speak with any potential providers that you're interested in or that you currently work with. Talk about the portfolios, get the snapshot of the portfolio, and most importantly, get what the investment thesis is. What is the purpose? Your management. What is the goal of management? Which sometimes, the benefit that's touted very often is diversification with synthetics. At the end of the day, sometimes it's just a hodgepodge of different managers kind of put together, and there's really no cohesive investment strategy. So I'll just put that out there. Any other questions, Paul, or do you want me to move on? And did I answer that question?
You did. Should we hold off the due diligence questions till later towards the end, or do you want to, answer a few now, or when's good?
Let me go through, because I'm going to get into that meat and potatoes right now. So let me change.
Sounds good.
Let me go to the slides here. So, speaking of due diligence, right? So that's a great point. Why is it overlooked? Quite frankly, I was just reading a piece by Brad Campbell, who many of you may know if you do work in the retirement side, ex-assistant Secretary of Labor, does a lot with ERISA plans and works for Drinker Biddle. He put out a piece, and it's shocked me, although it's related to asset allocation funds, specifically target date funds, that 73% of companies and plans have a due diligence process around their target date funds. So he made the comment, and when I read that, I felt the same thing. Why not 100%? Especially that's where the bulk of your assets are going. So I would say the same thing should be asked about your capital preservation option, no matter what it is. Why is it overlooked? Why don't you have one? And many programs, platforms don't. And at the end of the day, I can make an argument that that's just as important, because that is your safe harbor. That is where your participants, your beneficiaries are going to go when there is time of crisis and time of volatility and for some kind of stability. And you want that to be there, right? So here's some of the reasons why. Most of them, some it can be extrapolated to 529, but some of this also does apply specifically to the retirement side. But nonetheless, it's something to ponder and a good discussion to have. So thank you, Paul. So as the last bullet did say, a lot of the normal due diligence features or ratios, a thing that you look at, things that you may look at like this, like the items listed to the left, would not be applicable or fully applicable in stable value world, especially with some of the insurance separate account and general account stuff. So there is a perfect example to the right of a Morningstar fact sheet that you may be familiar with, but at the end of the day, a lot of it doesn't, that square peg does not fit in the round hole, in terms of due diligence. So what does, Paul? Where to begin, right? So I'll go to at the end of the day, the last slide of this presentation will tie it all home. There are different considerations, but going into it, where do you begin, right? At the end of the day, it goes back again to my comments before. There is no superior product. There is no superior version or structure. It's what works for you. So it could be stable value. It could be a synthetic. It could be a stable value general account. It could be a FDIC account, depending on the situation. So let me get into this. I'm going to focus, though, as I mentioned before, on two separate insurance company, on the two primary options here, the synthetic and general account. But before I do get into that, let me share a story and some of the gray hairs. This is where I got them from. Going back to the 08-09 time period. Again, this is not bashing any particular style. It's showing that how some things may be sold or positioned out there, and the reality is different. So comes the market downturn. Okay, we had a lead stable value. We offered others. They were all synthetic. We had to. At that time, we couldn't use insurance based. And the liquidity, things dried up, and all of a sudden, decisions were made that, hey, this is not a core business of ours. We're getting out of it. The same thing was said about said by several wrap providers. And then we had to do literally in a very short amount of time, a lot of due diligence to basically move over $2 billion and get $2 billion invested in the safe port and storm, allegedly, right? So this is when you need your capital preservation options. And unfortunately, during that time period, I got the gray hairs and the battle wounds to prove it that, things weren't out there as they were positioned. So what did I find with the synthetics that we used? Some of the things I mentioned before, the capacity dried up. Things were sitting in cash up to levels of 30% in some cases. So it's just something, again, not saying that style is, or that structure is bad. It's something to be mindful for, and make sure you ask the right questions to make sure you're asking and getting a synthetic, if that's your comfort zone, that you're getting a product and providers that align with your program's needs. So here's the illustration of an insurance general account. Fairly simplistic. So you have to evaluate, excuse me, the insurance company, that safety, stability, balance sheet, its style, its investment thesis, and then its history in the business, in the industry. Was it adding liquidity, or was it sitting on the sidelines, or did it come into the business to add liquidity during times of stress? That's important, right? And I would say, again, that's a question you should be asked across the board. But here is the illustration and how it goes. So typically it's a general insurance company, the general account, which feeds guaranteed type products, and then the wrap provider, which very often is one and the same. So again, these are some of the things that I mentioned. You need to look at the crediting rates. They are important. The contract provisions and portability, that's more important in the DC world, but nonetheless, it could be an important consideration for some. In terms of the synthetic world, the CIT world, it's the stable value manager itself. So same questions. What kind of history do you have? Basically, a lot of the questions I mentioned before and items to ask. But then it gets a little bit more complicated because you have the investment managers, multiple wrap providers, and you have to kick the tires. Not only kick the tires, but you have to do your full due diligence on those providers, because at the end of the day, as I learned from my experience, you can be left high and dry or just in cash. And then ultimately you have your multi-wrap portfolio. So again, what are the questions to ask here? Very similar: financial strength, the performance, expenses and fees. There is a piece that is included. I encourage you to reach out to our team or myself, and there's some good pieces that are attached here for your download, which will give you a good framework to get a little bit deeper on the concepts I'm exploring now. One of them is fees and expenses. It can get a little dicey with being able to interpret no matter what the structure. And then, of course, contract provisions, which is true for all. So what's important to you, right? So is it current crediting rates? Is it historical performance? Is it guarantees, right? If you're looking for guarantees, then that kind of helps you funnel down to a certain spot. Is it the financial strength ratings? That, I would argue, needs to be very important, especially if you're looking for guarantees. Fees and expenses, everybody wants reasonable fees, expenses, and to be as transparent as possible. And then the exit provisions. So I mentioned that because sometimes, right, you get questions, so kind of what's going on here, and what, which one is better? Again, none is better, but strictly in terms of performance, when you look at the various studies, typically, and that go back, that have a significant time period to look at, typically general account products would return a little bit more than separate accounts, which would return a little bit more than synthetics. So I mentioned that because, the question is, well, why and why do these exit provisions vary? Because, of course, the guarantee, in some cases with some of the products, as I mentioned, you have these guarantees, and you need to protect the investors that are currently investing in there. And if people are coming in and out nilly-willy, that would cause disruption. I need to stress, though, what that refers to really is plan level or program level, large scale, large asset moves. Participant transactions typically are fully benefit responsive. So participants, individuals, they can move without issues, unless they happen to own, half the total portfolio. Of course, that would be might be a consideration there. So with that, why due diligence? What's the importance of it? Why do you have to understand? Do it. Put a program together. Well, because at the end of the day, it'll give you a better understanding of a significant, important asset class, especially in volatile times and times of stress. It'll give you a better understanding of all available options, and I'm not even talking about just stable value. Certainly in 529, it'll give you a better understanding and understanding of the nuances of other products like money market and FDIC accounts. And then at the end of the day, many of you are fiduciaries and making fiduciary decisions. So it's to satisfy those obligations and those promises that you made to your clients. So, Paul, with that, I will put this up on the screen, the fun stuff that our attorneys and our compliance folks like us to do. I will pause here and see if there's any other questions.
Yeah, talking about times of stress and, with the S&P going down 900 points, this week on Tuesday alone, right? What is, just as a brief education for, what is SVIA? I see that around quite a bit, and what's the intro for that group?
Yes, so the SVIA is the Stable Value Investment Association. It is a stable value industry organization resource that does a lot of things. Like they do a lot of research and they evaluate legislation out there and all that kind of fun stuff. But it's an industry organization. They put out a lot of good independent data.
Sounds good. Yeah, just changing over, Mary, to the CNBC big screen for Ed and I. So, what's interesting for me in thinking about, the topic of liquidity, but obviously with everything going on, nowadays, it seems like Jerome Powell, it seems like there's such a great focus on liquidity where, that 2008 was, that's probably where the tripping stones were. And so it is helpful to kind of think about, where we are today versus 2008. Is that one smart way to look at it? It's like the reason why things are different now is because they know it's an issue that they're they're focusing on liquidity head on right now. And how do you kind of compare this scenario versus that and things like that?
Yeah. So I think, listen, at the end of the day, responsibility is never absolved, but I think the regulators, different people here today than were 12 years ago, but definitely lessons were learned. And the government this time around, within the last couple months, definitely did, what was it, 9 different facilities, set up 9 different facilities to keep things moving and did so. Like when you talk to our portfolio managers, they all say that they did a pretty good job in propping that up to keep things greased. So definitely, that's better. But in times of stress, listen, something's going to happen. Just coming from our organization, who we are, we've seen a lot in 175 years. We don't know what's going to happen or when it's going to happen, but we know something is going to happen. And that's why, we act like we do. And that's why we constantly build a strong balance sheet to basically deliver on the promises that we've made to you all and to our clients. Thank you.
And, one of the great things about covering this industry is just all the friends and family we have across the space, and even our blog is called 529 Insiders, that showing the love for the those that are deep in the space. And so this question comes in for Kay, and if you're a 529 Insider, who Kay is. So the question for you, Ed, is with rates so low, is now the right time for a 529 plan to consider to add this option? I can add my response, first, but I'll let you go, and then I'll be happy to add on my take. So Ed, do you want to take that one away?
Yeah, sure. So, okay, great question. It's a question we're getting a lot, and I know you live it every day. So I definitely, and I've been in your shoes, so I definitely can empathize. But listen, what do we know? What are the facts, right? So we do know Mr. Powell did say that it's lower for longer, and that's looking to be until the 22-23 time period. Now, of course, things could change, but that coupled with what's going on in the money market space and the regulations over the last several years that have really focused and the money market funds on what they can invest and can't invest in. Again, I go back to my comments before. It's really, not a fair fight. And the stable value funds, by virtue of what they are and the virtue of being able to go out further and have a further duration and have and use intermediate type vehicles will benefit, and we expect it to continue to benefit versus money market, as like we've seen in the past. Great question.
Yeah,
Thank you.
I used to be a Fed funds trader, and we used to at times not even pay out that 1 basis point. So that's the average across the 30 days. And there, it's a gruesome comparison on that, on the FDIC insured money market. So I know for when I think about this long-term low interest rate environment, stable values, the way to go, and especially as it compares on that, Morningstar and savingforcollege.com, type of ratings. We did have a quick question from someone else about that Morningstar ratings. Thank you, John Finch, for the questions. But yeah, it's been great to see Morningstar drop the ratings on 529s, and we do think it's only a matter of time that Morningstar starts to rate able programs as well in terms of that time frame. Who knows? But I mean, I think they've already started to post some of their performance ratings online. So we would think 2021 to 22 would be one way to go. But going back over to Brian Sullivan, I believe the higher relative returns of stable value appear too good to be true. How are stable value funds regulated? Is that part of the SVIA? So it's more of like a industry association, or is it more of, is there those the FINRA MSRBs of the world, or where's the oversight as it relates to stable value?
Yeah, so for the most part, they're not a great question. They are not governed or regulated by the SEC. Primarily, the governance does fall on the OCC and especially the state insurance commissioners, for sure. In terms of too good to be true, and Paul, interestingly enough, I know you had your great 529 conference last month, and I got a similar question. No, it's not pixie dust. Stable value funds, as you see, have a long established history over 40 years plus. But I can understand why someone may say that may not be totally familiar with them. But at the end of the day, it really goes back to, I would say, issues that more affect the defined contribution retirement plan side, because there are things called like equity wash, which if you had daily trading activity, which 529 doesn't, you may be restricted in going into another capital preservation a fund directly or for a certain amount of time before you could switch and exchange back in. So that is a hurdle, and then also compared to money market funds are 40 Act funds, right? As I mentioned before, no matter what structure, be it a synthetic, separate account, or general account, if the program decides to make a move, not the individual, but if the program decides to make a move, that depending on the market environment, there may be a time frame that may take, and that could be anywhere from 12 months to 60 months.
Got it. Yeah, that makes sense, and much appreciated. As a quick side note, I'm a big reader of all different financial books. The book called like the richest person in Babylon. There was a focus on just have a great return, but don't lose money. It was just a very big chapters like don't lose money, right? So it's like if you look at some of the tables, like yeah, you can do really well on that 20-30 year time frame with like a REIT, but it's like it's the most volatile thing out there, and it's just obviously with everything going on today. So it's and of course, as I like to say, I mean, I think we could all use a little bit of stable anything in our life. With so much going on, it's like at least you can get some stability on your investment lineup. But just thinking about that as well, and as you kind of talked about that how different plans differentiate themselves. There's that 175 years of track record. Of course, I see the CTA just pop up right there. But yeah, I mean that longer track record, and just learning as I am more about the space. I mean, like you would want like a credit rating on the insurance firm that's as high as broadly possible, which your team does have. And is there any use scenario why you would go with one with a lower rating, especially with things nowadays? I'm just curious, out of curiosity. Like it would appear that there would be concentration on those with great ratings. Is that a fair assessment, or is that sort of just sort of like something else altogether?
Well, Paul, the reality is sometimes people especially those that may not be that versed. They may just be shopping for yield, shopping for a stated return. As part of the due diligence, again, in my paper, I write that you have to see, is it a composite return or is it actual return? How transparent can you get the returns, and how quickly? So that's part of the due diligence vetting. At the end of the day, you bring up a very good point. Annuities are in defined benefit plans have been used quite a while, for quite a while. Income annuities, obviously in 529, not so much, but technically these are group annuities. And quite frankly, I would use and refer to the DOL's Interpretive Bulletin 95-1, which has been used in the DB space for quite a bit of time. I would Google it. There's a little bit to go through, but at the end of the day, it says, look at the provider. What is their rating? How what's their quality and diversification, not only of the portfolio but the business lines. Their surplus, their financial strength rating. And in so many words, I think the bulletin does go out to say, although I haven't thumbed through it in a while, I think it said at the end of the day, all things even, you need to go with your highest rated, the strongest annuity provider. And I think listen, that everybody has a story, but I think that's a prudent approach.
Sounds good. And looking at the time clock, 1:46 p.m. Just want to see if there's any two I guess I'll focus with this. What is the key takeaway that you want the audience to see today? And if you don't have that key takeaway, what are the two myths that are just straight up wrong that you want to close out with saying? What's the final statement, Ed?
All right, key takeaway. I've said it a million times. I'll say it again. Do due diligence or work with your folks to do due diligence on this asset class for your program, for sure, or for your clients. The takeaway, don't forget it. It is very important. Remember what the space is. It is the safe port, and you don't want volatility in it when there are times of distress. So again, nothing I haven't said. Those are the two main takeaways. Oh, and I'll add one more that's related. They're not riskless, right? There's risks to everything. So just keep that in the back of your mind as you put the framework together.
Sounds great. And thank you so much for your time and insight today. There is handouts. We're going to send a follow up thank you as well. I'll pop back over to the slides view for the recap. So we provide industry announcements, data research updates, talked about the advisor sold channel, stable value product. We do have our next webinar currently scheduled on November 17th. Education is important, therefore creating the college financial plan is important. And as you have questions on stable value, definitely reach out to Ed. In the meantime, enjoy the trick-or-treating, enjoy the weekend. Thank you so much for your time today, and we'll be catching up soon. Thank you.